Welcome to the November Hacks Roundup, where we cover all the largest hacks in November in just one video. If you aren't subscribed already, go ahead and do so that we can cover the December hacks as soon as they're available. In November, $343 million were lost due to Web3 security incidents. $88.5 million was lost due to smart contract hacks, $1.5 million was lost due to reg pulls and scams, and again, the most money was lost due to compromised keys at $253 million lost. This has been the worst month yet for 2023, and the block reports that CeFi was the primary target, accounting for over 53% of the total losses. In total, the amount of funds lost in November is 15 times that was lost in October. The first hack we'll be covering is the KyberSwap hack. KyberSwap is a DEX aggregator that also serves as a liquidity protocol. KyberSwap features elastic pools which allow liquidity providers to allocate their liquidity among specific price ranges. On November 22nd, KyberSwap elastic pools suffered an exploit where approximately $48 million were stolen across multiple chains. Before we get into the details of the hack itself, let's describe some differences between concentrated liquidity market making and traditional market making that may be found in protocols such as Uniswap v2. In this concentrated liquidity market making model, liquidity providers can allocate their capital to preferred price ranges, allowing them to create individualized price curves. LPs will then earn trading fees from transactions that occur within these specific price ranges, and their earnings are tied to the effectiveness of their chosen price intervals. These concentrated liquidity market makers aggregate all of these diverse, finite positions into a single liquidity pool, which you could see here. So each of the price ranges are finite itself, and they're sort of combined into the whole liquidity pool. Because of the finite nature of this liquidity provided, this means there's a limit to how much liquidity can be allocated and traded, which is different from traditional automatic market making approach, where there's liquidity sort of existing infinitely across all price ranges. Here's a visualization of the LP positions within an elastic pool in KyberSwap. In this example, there are 3 LP positions, and each LP position is divided among the price ticks based on the LP price range. For example, if the price of the asset here were to fall below tick T4, the price will exit the liquidity range for position 2, which we see here in blue, but remain within the ranges for position 1. Therefore, the liquidity available for trades needs to be updated to exclude the liquidity from position 2 if we were to go below this price range tick T4. Similarly, if the asset price were to rise beyond tick T8 over here, that would exclude the liquidity available from position 2 while still being in range of the liquidity available for position 3. Therefore, when the asset price drops to below tick T8, it will include the liquidity of position 2 again. So if it goes above, we don't have position 2. If it goes below, we do. This provides a new way for liquidity providers to participate within the protocol. However, we need to ask ourselves, is it possible to cross a tick range without modifying liquidity? So would it ever be possible to exceed price tick T8 and still have the liquidity in position 2 available? If that's the case, something's gone wrong within our elastic pool. This is what happened during the hack itself. So from a high level, let's take a look at what the attacker did on the KyberSwap hack. First, the attacker swapped into a pool to remove all liquidity positions from the pool. This created a sort of blank canvas for the attacker to manipulate the protocol into a vulnerable state. The attacker had to mint an LP position and then reduce an LP position to get the inputs and the state of the pool where they wanted. The attacker then swapped into the new liquidity position to trigger the liquidity bug. The price after swapping crosses an LP tick, but we did not adequately update liquidity from the pool. Once we have gone beyond the tick, the attacker swapped in the opposite direction to have a liquidity added twice to a range of liquidity provided within the KyberSwap elastic pools themselves. The attacker was able to force the protocol to make this double add of liquidity by bypassing the call to the function update liquidity and cross tick when executing a swap. The attacker must have been very knowledgeable of the protocol because this required very, very specific inputs. Without there being an adequate update to the liquidity available within the certain price range, this base liquidity variable within the protocol was unchanged following the second swap the attacker did. During the third swap, the attacker is able to swap back into the LP range, which triggers the function update liquidity and cross tick. Since the liquidity was not removed in the previous swap, this base L value actually doubles. So now the protocol believes that there is twice as much liquidity than there actually is within a certain price range. So what is the root cause here? How was the attacker able to let the protocol bypass this update liquidity function? Well, the protocol assumes that if the next swap price is not equal to the max price within the liquidity range in the direction of the swap, of course, I believe these were sells or buys, they're different directions. But if the next swap price is not equal to the max price, then we didn't cross the LP tick range, and therefore we do not need to call update liquidity and cross tick. So why does the protocol assume this? How is the price after swapping calculated? So how exactly is the next price determined when we're swapping in an LP range? Well, we look at the approximate change in liquidity because KyberSwap also includes something called a reinvestment curve. So we're going to calculate the next price based on how much the liquidity changed, which relies on this function estimate incremental liquidity. However, in the estimate incremental liquidity function, which you see over here to the right, there was a rounding error that caused the estimated change in liquidity to be lower than it should be, which resulted in a higher price calculated after swapping. BlockSec was actually able to identify a discrepancy between the dev's comments to round up delta L, where we see in the code itself, we're actually rounding down through this mul div floor function. Now that we've seen a little bit about the hack itself, let's see how the KyberSwap team reacted. And for those of you on crypto Twitter, most of us, right, we saw that this KyberSwap hacker was quite villainous in his response, right? But shortly after the hack, the KyberSwap team publicly acknowledged the exploit on Twitter, and the attacker left these on-chain messages, these villainous on-chain messages, indicating that they were open to returning the funds. The KyberSwap team agreed to share 10% of the bounty for returning funds and also negotiated 10% with the bots that front-ran protocol funds during the hack. So far, no funds have been returned by the hacker. So this was a complex hack, and we want to ask ourselves, how could this be prevented? So a couple of things are taken out from a post-mortem by 100 Proof discussing this vulnerability. So they mentioned a couple of invariants that should always be respected when working with CLMM. From traveling left to right on the graph, the liquidity should start at 0 and increase or decrease on the leading trailing edges of the tick range. The liquidity should never go below 0. And when swapping tick range boundaries, you should never cross a boundary without the liquidity being increased or decreased. So if these invariants were in place, perhaps it would have been detected that range was crossed without a change in liquidity. dYdX's hack was made possible by market manipulation. dYdX v3 is an order book-based decentralized perpetual exchange that runs on the dYdX ZK rollup. Some components are centralized and they feature over 30 trading pairs, some of which can go up to 20 times leverage. On November 15th, $9 million was lost from the dYdX insurance fund due to the market manipulation of Yearn Finance's Wi-Fi token. The price of Wi-Fi unfortunately dropped by over 40% after the exploit. Perpetual exchanges require traders to post a margin to cover the losses from their positions. During volatile market conditions, the margin may not cover the losses, especially when using high leverage. If the margin cannot cover the losses, the remaining losses are taken from the insurance fund that was likely set up by the protocol itself. On November 18th, because of the rapid downward price movement and liquidations, The margins were unable to cover the position's losses, and therefore funds were drained from the insurance fund of dYdX. To give a quick example of how margins work in a perpetual market, let's say you want to long the price of BTC. If you're creating a position size of 10 BTC with 10 times leverage, you'll post about 1 BTC as your margin. But if the price of BTC were to very rapidly decrease by more than 10%, your entire margin would be lost and you won't have enough to cover the shortfall of your position. So that is when the insurance fund comes in to hopefully force the liquidation and cover anything that may not have been able to be covered by the margin itself during these turbulent market times. So let's take a look at what the hacker did. This graph shows the price of the Wi-Fi token on CoinMarketCap surrounding the time of the hack. The attacker started by depositing USDC and creating some long positions among multiple accounts that they controlled. This was to kick off the price manipulation to increase the price of Wi-Fi and create this positive trend in the market. Once the price has significantly raised, the attacker is going to close out the long position to realize their profits from their long positions, as well as opening up some shorts. Once the market starts to catch up, you see the price decrease, which triggers all the liquidations among remaining longs of the Wi-Fi token. This rapid downward price movement triggered a lot of liquidations where the margin could not support the losses that were assumed by these positions on the Yearn Finance token. Once the price broke low, the attacker closed their shorts and withdrew the funds. And here we can see all these liquidations are stealing the funds from the dYdX insurance fund. And the attacker was anticipating this. So once the price got all the way down, he was able to close out his shorts and withdraw his profit. Now, the details of how exactly the market was manipulated are a little difficult to find, but most of it occurred on dYdX itself. One indication of how this market manipulation may have occurred is the relationship between price and open interest on a market. Oftentimes, you can detect a strong market trend if the price and the open interest on the perpetual market are heavily correlated and they're both going up at once. As we saw in our previous graph with the long positions and the open interest going up, this signaled to other traders that there was a strong positive bullish trend for the Wi-Fi token. On the other hand, if the price were to be going up and the open interest were to be going down, there's a weak trend here in the market. This would suggest a reversal in the price. So this increase in open interest in the price of the Wi-Fi token likely encouraged other traders to get in on this long position and just sort of create the rally that the attacker was able to eventually profit off of. Following this attack, the dYdX increased their initial margin requirements for lower liquidity tokens, including Wi-Fi, and the team is not offering any bounties to the attacker itself, but will offer bounties to anyone who can provide information leading to fund recovery. The team has reported this information to the FBI and claims to have made significant progress in identifying the hacker. The dYdX chain, not V3, their current version, will also have the following updates: the ability to update the maintenance margin requirement, the maintenance margin scales with position size, and redesigned liquidity engine. To prevent an attack like this occurring in the future, you can implement stricter margin requirements for low liquidity tokens, changing margin requirements based on market conditions, and enforcing a cap on open interest. The Raft finance hack ultimately occurred due to rounding errors, which is the larger theme we're seeing in the November hacks. Raft is a DeFi protocol on Ethereum that allows users to mint R, the protocol's stablecoin, by depositing liquid staking derivatives as collateral so that you could borrow while earning your staking rewards. This project is the humbling reminder that audits do not guarantee a bug-free protocol, as it had undergone multiple audits by Trail of Bits and Hacks Finance. The hacker made quite the grave mistake and lost all $3.3 million of ETH profit by accidentally sending their stolen funds to the burn address. They ultimately ended up spending $8,000 out of pocket during the hack itself. So before we get into the details of the hack, let's talk about a couple root causes of it. Similarly, in other hacks, reading the balance of the contract directly is a recipe for disaster. The share calculations were heavily reliant on this index, which was relying on the balance of the contract itself. This value could be heavily inflated by just transferring in a large amount of these collateral tokens, which is eventually what the hacker did. A second major root cause here is that the shares being minted for the user was rounded up instead of down. This allows the attacker to mint 1 share worth of Raft Coinbase ETH for 1 way worth of CB ETH after they inflated the index used in the share calculation itself right here. Usually, you would expect the attacker to have to deposit at least B of underlying tokens to get 1 share. However, even if this rounds down to 0, there will always be a share minted to the user because we are rounding up here. Now, to look at the hack itself, first the attacker creates a small position, and this is because they need something to enter the liquidate function within the contract itself, which is where the index gets updated. After they've created the small position, they receive a flash loan of 6,000 Coinbase ETH that is then directly transferred to Raft's interest rate position manager contract to significantly inflate this balance. On step 3, when they liquidate their previous position, the index is now seriously inflated based on this line of code that we saw in the previous slide. So set index collateral token dot balance of address this. That index is heavily inflated now because we just transferred in a lot of funds. Now the attacker repeatedly mints themselves 1 way worth of Raft Coinbase ETH. They do this 60 times. This resulted in a collateral position of 10,050 Coinbase ETH, which is also due to the balance of being reliant on this index that was inflated. Now, with these Raft Coinbase ETH shares, they have a large collateral position, which allows them to, well, the protocol thinks they have this large collateral position, which allows them to mint 6.7 million worth of uncollateralized R token. Following the minting of the token, they swap all of the R they just minted to USDC to WETH on Uniswap. However, they lost all profit in this step 6 here. The attacker forgot to initialize the address to send funds with in the calling contract, which delegated a call to an implementation contract. Now, the attacker unfortunately forgot that when you're making a delegate call to an implementation contract, you're going to be reading the state of the calling contract itself. Unfortunately, this address wasn't configured in the state of the calling contract, the attacker contract, so he did us all a favor and burned $3 million worth of ETH by sending it to the 0 address. So now everybody's ETH is worth a little bit more. The response by the team was prompt. The attack took place at 13:59 Eastern Standard Time, and by within 10 minutes, Ancilla security firm was able to tweet the attack transaction to Raft. Raft was able to acknowledge the attack shortly after. However, the Tempest Labs Finance, which is the DAO building Raft, has yet to comment on the incident. About an hour after the team acknowledged the attack on Twitter, they tweeted that the minting of R will be paused until further notice. However, the users were still able to repay their debts. Now, through March 31st, 2024, the team is going forward with a 42% recovery plan for users. The Raft team has also made clear on their Twitter that they are working with the law enforcement to try to identify the hacker. To prevent a hack like this in the future, developers and auditors need to be very careful about how you use the balance of function. Technically, it's manipulatable by anyone, so it shouldn't be relied on for very sensitive protocol actions, such as the amount of shares to mints and the value, because this value could be manipulated by external callers. So instead of relying on balance of itself, there should always be some sort of internal accounting that takes place. Also, when minting shares, it's best to generally round down. We aren't trying to give users less, it's just to be on the safer side to maintain the protocol's financial health and avoiding bad debt. So in this case, a big reason this occurred was because the shares being minted was rounded up instead of down. Additionally, we can see that audits are not enough here and that we should really start to rely on fuzzing techniques to unveil some of these protocols' miscalculations. And furthermore, fuzzing tools need to be further developed. The Onyx hack occurred because of the Compound V2 empty market exploit. Onyx is a Compound V2 fork lending protocol where users can supply, redeem, and borrow assets across multiple markets. On October 28th, Onyx Improvement Proposal 22 was proposed to support a Pepe market. On October 30th, this proposal succeeded with only 11 addresses casting votes, and on November 1st, the proposal was executed and the Pepe market was added with no initial liquidity. Shortly after the proposal execution, Onyx markets were exploited for approximately $2.1 million on Ethereum. Before understanding the attack, we have to understand the empty market vulnerability present in compound forks. New markets without initial liquidity are vulnerable to exchange rate manipulation between the underlying asset and the respective Onyx O token. Attackers can inflate this exchange rate by depositing a small amount of underlying tokens, followed by donating a large amount of underlying tokens, which often just look like sending a lot of tokens to the pool contract itself. Attackers can then borrow large sums of underlying tokens from other markets using this inflated exchange rate and reclaim nearly all their underlying tokens from the inflated market by exploiting the rounding errors present. Utilizing liquidations, an attacker can empty the vulnerable market and repeat on all remaining markets. Here's a closer look at how this exchange rate manipulation occurs. An attacker will supply a small number of underlying tokens to the empty market and receive O tokens in return, calculated using this initial exchange rate, where the O tokens received will be equal to the underlying assets supplied by the exchange rate. After there's a large amount of underlying tokens transferred directly to the market contract, this inflates the underlying token to O token exchange rate, and the O tokens are actually worth a lot more than the underlying tokens, based on this formula below. Now, with the significant inflation of the exchange rate, attackers can now borrow significant amounts of other assets from Onyx markets while maintaining a sufficient collateral to debt ratio. That's because this collateral value is calculated by fetching the underlying asset price multiplied by the exchange rate and the collateral factor. Despite having a small number of O tokens, the attacker's collateral value is very high, and they can borrow and drain other markets within the broader system. Rounding errors occur when an attacker has a sufficiently small number of O tokens and is redeeming almost all underlying tokens. The rounding error inflates the underlying token per O token exchange rate. An attacker can redeem nearly all underlying tokens with significantly fewer O tokens by exploiting this inflated exchange rate. After redeeming their underlying tokens, the attacker can liquidate themselves, empty the pool, and repeat the exploit on other Onyx markets. Now that we talked a little bit about the empty market exploit, we have to take a look at how the empty market was actually created on Onyx in the first place. And this was all because of this proposal mentioned earlier, OIP 22. This slide shows the 6 transactions that occurred to perform the initialization of the new Pepe market. First, the Pepe price feed was set using a Uniswap v3 TWAP oracle. You add Pepe market to the Onyx controller, you set the collateral factor, you set the market caps, you set the borrow and supply rates, and you set the reserve factor. However, the one major thing that made this attack possible was that the proposal didn't include a transaction that supplies the liquidity to the new Pepe market. Therefore, the empty market vulnerability just discussed is now possible to exploit on this Onyx market. Unfortunately, the Onyx team decided against a security audit for this proposal because it was believed to be a heavily tested step of adding a new market. Additionally, it's important to note that only 11 addresses actually participated and voted on this proposal itself. So after the proposal was made on chain, the vote occurred. It was queued for execution. As soon as the proposal was available for execution, the exploiter executed the proposal. Then, within a minute after that, they deploy their exploit contract, and in the following block, they actually carry out the attack. Now, to look at the attack from a bird's eye view, first, you wait for the attacker waited for the proposal to be executed. Then they received a flash loan for 4,000 ETH and swaps to Pepe via Uni V2 pool. The attacker utilizes the initial exchange rate to supply and redeem a small amount of OPepe. Then they inflate this exchange rate by transferring in a large amount of Pepe, 2.5 trillion, to the market itself, and significantly inflate the Pepe to OPepe exchange rate. So you can see the inflated price down here is very significant. Because of this, the attacker's collateral value is now heavily inflated. And with a collateral factor of 0.5, they can borrow up to half of this collateral value, which means the attacker, with just a small deposit, 1 way worth of Pepe, was able to trick Onyx into thinking it has $1.4 million worth of collateral. Following that, the attacker then borrows all assets from different markets in the system. The attacker then redeems nearly all of their donated Pepe by exploiting the rounding error. Then they liquidate themselves with a small amount of the borrowed token and allows the attacker to empty the Pepe market again. They then redeem the remaining OPepe tokens and empty the market, and then they repeat on all other remaining markets on Onyx, swap all the stolen funds to ETH, and repay their flash loan. Overall, there were $2.1 million worth of assets stolen. Their breakdown you can see below. And there were a number of people that reached out to the attacker's address directly on chain, asking for some funds back. And the attacker actually gifted 19.5 ETH to addresses that asked, and the remaining ETH was moved to Tornado Cash. None of the stolen funds have been recovered. The response from the team was disabling all supplying and borrowing of Onyx coin tokens on markets. The Onyx community has since voted on 5 propositions regarding how to compensate users, and 4 out of the 5 propositions were defeated, with the fifth one succeeding. They will be launching a new improvement proposal targeting the primary markets on November 29th. The V1 markets will be closed, and there will be a snapshot of suppliers' balances for eventual compensation down the line. To prevent a hack like this in the future, the proposal itself should have included a transaction to supply a small amount of Pepe to this new market. Ideally, the received OPepe would be burned to ensure the Pepe market always has a non-zero total supply of OPepe. If the Onyx team realized that the proposal would lead to an empty market before execution, they could have canceled the proposition, or after the proposal was executed, in the minute before the exploit actually occurred, if anybody else had supplied Pepe to the market, this wouldn't have been possible. Now we'll talk about some other hacks that occurred in November. Some MEV bots were actually targeted by attackers a lot more than other months that we've seen. On Tuesday, November 7th, an MEV bot lost $2 million in total. The bot address actually held 610,000 USDC, about 1.1 million USDT, and about 308 WETH. So there was a lack of access control on public swap functions within the bot. The attacker was able to recognize this and force the bot to make swaps that he could then trade against. The attacker took out a $50 million flash loan to fund this sandwich attack, and in the form of 27 WETH, profited $2 million. So he basically forced the bot to trade into less favorable positions that he then traded against and was able to profit $2 million off of it. In another instance of an MEV bot, $365,000 were stolen because, again, no access control was on a critical function. In this attack, the attacker was able to assign themselves as the privileged address to just harvest assets held by the bot. And in a smaller hack but still the target of an MEV bot, there was no access control on a critical function, which allowed the attacker to escalate their privilege to become the remove admin, which allowed them to remove all liquidity managed by this bot and swap it for profit. So, a friendly reminder, if you've written a MEV bot a couple of years ago, might be a good time to do a maintenance check on it. So some smaller hacks that occurred, we see the standard IO was hacked for $264,000 due to a lack of slippage protection. The attacker was able to make a collateralized debt position with 10 Raft BTC as collateral to mint 290,000 euros. And when this position was created, the protocol was forced to swap into a Raft BTC PAX G pool and receive very little PAX G for still supporting the minting of the euros. And then the attacker was able to drain the liquidity on another exchange. We also see a lack of slippage control in this Grok token contract, where $52,000 were lost because the attacker knew they could force a swap tokens for ETH function to be invoked if the token contract balance exceeded a certain threshold. Then, after forcing the sale of Grok into WETH, the attacker could trade against it to increase their Grok holdings and dump back into WETH. Some other smaller hacks occurred with the Teleport DAO bridge hack, where $200,000 were stolen when bridging to Polygon due to invalid BTC transaction parsing. And we see another lack of access control here with TrustPad, where they lost $155,000 because there was no verification on message.sender. So what the attacker was able to recognize was that they could prematurely harvest staking rewards by assigning a new lock start time to their stake. There was a bad K value verification for a constant value in a swap for linked out. And identical to last month's Hope money hack, Maha Len lost $20,000 due to a precision error. And unfortunately, they had to sunset their protocol after that hack. And just hours after launching, Mirage Finance was hacked for $12,000 by a repeat offending address that also hacked Beluga Dex. And unfortunately, Mirage Finance was unable to survive after this hack as well. In the largest category of hacks, where the most money was taken this month, we have our private key compromises. And mainly, this relates to Onyx. This exchange lost $118 million across ETH, Tron, and BTC. And this is the fourth time in the past 4 months where a project closely related to Justin Sun has been hacked. Similarly, there was an API compromise for Kronos Research. They were hacked for $26 million following an API key compromise. They're a Taiwan-based market maker, and after the hack, there were liquidity issues on their centralized exchange, WooX. So after their accounts were drained, there was a lot of scrutiny against this firm because it felt too similar to what we all went through with FTX, where they were using user funds on other exchanges and sort of misaccounting for users' assets and the fund's assets itself. There was a $258,000 rug pull this month. The DOR token was deployed 8 days before the hack, and ultimately it just lies in the transfer function here, where no transferring is actually occurring within the contract itself. There is this arbitrary address that is doing all of the transferring. So apparently the attacker was able to just pull the rug for all liquidity available on this token. This address has actually had quite the month. They created and rugged 2 separate tokens totaling over $300,000. So this address should definitely be flagged on the site if not already, or on any monitoring service. And not much more to it. Created the token and rugged it right away. There were also a number of fake tokens that were created this month, got people to buy in, and just rug pulled. So for investors out there, always double check that you are investing or interacting with team approved contracts or tokens. Some trends that we noticed this month about the vulnerabilities were, first, several MAB bots being targeted. As I mentioned earlier, this might be a good time to do a security check on any old bots. And I believe that these bots are getting targeted because the space is growing and the knowledge is generally growing, so they're a little easier to detect. There was a surprising uptick in scams and fake tokens this month, so please be careful out there. Centralized finance was targeted all throughout November, and there were some repeat offenders this month. So this suggests that there can be monitoring services provided around these malicious addresses. In my opinion, there's no reason that an address should be able to get away with this twice. Also, attackers have been capitalizing on contracts that are reliant on the contract's balance for internal calculations. Attackers will donate funds to protocols to disrupt internal accounting, but that's because the contract itself is too reliant on the balance of function. To avoid this kind of stuff, developers need to keep in mind that they should implement some sort of internal accounting and not relying on the balance of function itself, as that is technically manipulatable by anyone else. Additionally, rounding errors were a common trend in exploits this month and a broader theme throughout the year. A trend that we're seeing in the responses, or that we almost have immediately, or protocols are immediately beginning to work with law enforcement. So like even the FBI getting involved, we're seeing some of these bigger protocols not shying away from law enforcement, but actually working directly with them, which may or may not work out in their favor at the end. Additionally, another trend we're seeing is that many hacked protocols are able to at least provide some sort of reclaiming funds process for their users affected. With that, I hope you enjoyed our November roundup. Stay tuned next year for a December 2023 roundup, where we'll be covering the ERC 2771 hack and more. Special thank you to the other engineers who worked on this, Jisan, Jen, and Cameron. Thank you.